Hey guys, in this session, we will look at the one of the potential topic which SBR examiner can test in the current issues questions, right? Because in SBR scenario, in SBR current issues questions, it is not necessary that he will test about the recent developments. He can test those accounting concepts which you cannot expect in your regular questions and not a regular scenarios, but can be a practical one like this crowdfunding and impairment of financial instruments. And these are not my words, but these are examiner words actually, right? So do watch this lesson. Firstly, what we need to know that what is crowdfunding, right? Crowdfunding is the way of is the uh, crowdfunding is the funding of a new startup or project by collecting cash from a variety of individuals or entities, often via the internet, right? Now, there are four ways of raising funds. What are those? Firstly, we have equity based crowdfunding. What is equity based crowdfunding? The equity based approach is targeted at investors who receive shares in the new company. Number two, we have debt based crowdfunding. Now, what is this? With debt based crowdfunding, a contributor makes a loan to the business that's looking to crowdfund with the intention of subsequently being repaid with interest. Number three, reward based crowdfunding. This involves promising specific items, rewards to contributors before launch of a new project, product, or a business. A reward based campaign is not generally targeted at contributors who are looking to profit from their investment, but at those who want to own a new project. So basically, this it is like just offering a partnership in the business, right? Or share of profit from the business. And the fourth one is donation based crowdfunding. Donation-based crowdfunding contributors make donations to a project or company and may receive existing rewards in return. Some form of donation-based crowdfunding don't involve any sort of reward as donor wish to contribute to but further a particular cause. So now we have to look at the various considerations regarding it. Well, using the question scenario, candidates would be expected to break down a scenario and understanding the information, provided that it is candidates may not have considered the crowdfunding context before. However, they should be able to understand the accounting implications of four options above, right? So we will look at the accounting of the four options above, which I just discussed, right? For example, if the crowd fund is considered to be a debt instrument, it will fall within the scope of IFRS 9. Whereas if it gives rises to an issue of capital, it will fall within the scope of IAS 32 financial instrument presentation, right? So, number one scenario, as I said, if crowdfunding considered to be debt instrument, it will come under the scope of IFRS 9 financial instruments. If it gave rise to issue of capital, it will fall under IAS 32 financial instrument presentation. Right. If crowdfunding campaign involves issue of rewards, it will fall under IFRS 15, that is um, revenue from customers with revenue from contracts with customers should be used to determine when to recognize revenue for each performance obligation. The company will need to determine whether the performance obligation is satisfied over time, that is, control of the goods or service transfer to the customer over time. If one or more of the criteria in IFRS 15 are met, then the company recognizes the revenue over time. If none of the criteria is met, then control transfer to the customer at a point in time and the company recognize revenue at that point in time. However, if the company cannot reasonably measure the outcome but expect to recover the cost incurred in satisfying the performance obligation, then it recognizes revenue to the extent of the cost incurred. Right. So now let us look at one of the example over here. For that, just let me write an example for you. Right now, so here is the example. As you can see, on 1st September 2009, Burnett Company decided to undertake a crowdfunding campaign to finance the production of a new racing bike, the Kraken. They made a short film with famous cyclists, which settled the qualities of the Kraken bike and posted it on the Pedal Starter crowdfunding platform. The campaign raised $4 million, on which Pedal Starter charged 7% commission. The contributors to the crowdfunding campaign were promised a reward of one Kraken bike for every $4,000 contributed at the financial year end of 31st December 2009. Burnett Company had manufactured only 50 Kraken bikes at a total cost of $20 to 40,000, but none had been delivered to contributors. There was some doubt as to the capability of the company to develop, manufacture, and deliver the bike promised. But Burnett Company is sure that the funding will cover any costs incurred. So, what will be the suggested answer for it? In the beginning, what will say IFRS 15 revenue from contracts with customers should be used to determine when to recognize revenue. At 31st December 2009, it is difficult to know what the outcome will be. Outcome will be as only 50 bikes have been manufactured out of promised 100 bikes. How I get that? Dollar 4 million divided by 4,000. What I'll get? Obviously 100 bikes. And there is a doubt as to whether the company has the capability. Company has a capability to develop, manufacture, and deliver. To develop, manufacture, and deliver the bikes promised. However, Burnett Company expect to recover the costs incurred in satisfying the performance obligation. Thus, it will recognize revenue to the extent of the costs incurred to date, that is to 40,000 plus commission, it's gonna be 280,000 as at 31st December X9. The balance remaining from the crowdfunded amount will be shown as accrued revenue. Accrued revenue in the financial statements accrued revenue in the financial statement, that gonna be $3,480 triple zero yen, that means 3,480,000. All right, and the commission will be the commission of $280,000 would be charged against profit or loss for the period, right? So let me give some guidance over it. Many candidates may now have some extra time to reflect and think the values, the concerns, and the routines of one of which may be their approach to study. It may be a time to not focus on accounting techniques, but on accounting principles, right? So just read around the subject and gain an understanding of what lies behind it, right? What you need to remember? You need to remember number one, the importance of conceptual framework. Number two, an understanding that rules will not be able to cover all situations. Use of reasonable judgment is always needed in decision making process, right? So Now let us look at the one more important thing, uh, another technical area of SBR tables in which mostly uh, candidates do struggle is the impairment rules of IFRS 9, right? While using an expected credit loss ECL model, which required calculations of expected value decrease in financial assets. So, to give you a little bit revision, IFRS 9, first IFRS 9, the impairment of financial instruments. We have three stage approach. Stage one, deals with financial instruments that have not had a significant credit risk since they were recognized or that have low credit risk at the financial year end. For these assets, for such assets, what you need to do, uh, 12 month expected credit loss ECL are recognized, right? That means entity has to calculate credit losses for next 12 months. Which means that the entity has to calculate the expected losses in the next 12 months, taking into account the risk of default. Right? And any interest revenue is calculated on the gross carrying amount of the asset without deduction of credit loss. Stage two deals with financial instrument that have had a significant increase in credit risk since they were first recognized unless the credit risk is still low at the financial year end. At the financial year end, these instruments are not credit impaired. The expected losses over the life of the financial instrument are recognized lifetime ECI, taking into account the risk of default. Interest revenue is still calculated on the gross carrying amount of the asset. Okay. Lastly, the third step, stage 3 deals with the financial assets that are credited, impaired, which is worth events have occurred that have determined a detrimental impact on the estimated future cash flows from financial assets. From financial assets. These assets, lifetime ECL, are also recognized. However, interest revenue is calculated on the carrying amount less ECL allowance, right? So let us do a example on it. So on 1st January 2006, Lunar Company granted Kaiser Company a 5 million secured loan repayable on 31st December 2009 with an interest rate of 3% payable annually at the reporting date. Number one, we will look at the expect of stage 1, right? At the stage 1 on 31st December 2006, there is no increase in credit risk. Okay. Probability of default in next 12 months is 5%, right? So the present value of the cash shortfalls expected over the life of the instrument in the default occurs in the next 12 months is $200,000, right? So 12-month expected credit loss is 200,000 into 5%, 10,000, right? Interest revenue 5 million into 3%, $150,000, right? So no adjustment for any loss allowance required. Okay. Then we have stage 2. So for stage 2, on 31st December, X7, the credit risk of loan increased significantly. Okay, the probability of default over remaining life is 45%, and the present value uh, of ECL's expected credit losses from the default over even from the life of the loan are expected to be dollar 400,000 this time. So lifetime expected credit losses is equal to 400,000 into 45%, 180,000. The change of cumulative, change of dollar 170,000 in the cumulative impairment allowance is recognized in profit and loss. Okay, interest revenue 5 million into 3%. That's gonna be 150,000, right? And no adjustment for any loss allowance is required for this as well. And then we have finally stage 3. So as far as the stage 3 is concerned, on 31st December 2008, the loan is credit impaired. The estimated present value that is expected to be recovered. Less cost is dollar 4 million. The gross carrying amount of the loan is dollar 5,150,000, which is the loan plus unpaid interest for the year, which is loan plus unpaid interest for the year. Okay, lifetime expected credit losses is equal to 5.15 million minus 4 million. I will get 1.15 million, right? The change of 1.15 minus dollar 0.18 million in the cumulative impairment allowance is recognized in profit or loss. 2009 interest revenue is dollar 120,000. That is 3% into 4 million, which is based on gross carrying amount minus loss allowance. So for trade receivables or contract assets that do not contain significant financing component, the loss allowance should be measured at initial recognition and throughout the life of the receivable at an amount equal to lifetime ECL as an exception to the general model. If the credit risk of the financial instrument is low at reporting date, management can measure impairment using 12-month ECL, and so it does not have to assess whether a significant increase in credit risk has occurred. Right? So I hope the concept is clear. And now, if you get the question on crowdfunding, particularly, I hope you will do it well in the question. Right? Uh, I try to discuss those areas in which mostly candidates dates struggle, right? And now I hope you will do well. So see you next time with the next session very soon.